No one likes paying tax. Well, I don't know, but I do because I understand it's important, and boy do I pay my fair share of tax. But do you recognise that if Labor comes into power, they're going to make us one of the highest tax countries in the world, and there are 6 taxes that will affect you or could affect you that I'm going to discuss in today's show with Ken Race, and it's probably best to get a heads up before all this could happen to see what you can do about it. And I'm also going to discuss why there are currently so many property pessimists around, why so many people are predicting a property market crash. Welcome to this week's episode of the Michael Yardney podcast. I've got lots for you today.
Welcome to the Michael Yardney podcast, where each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property advice. Now here's your host, Michael Yardney, Australia's most trusted property commentator, who has once again been voted our leading expert in wealth creation. That's the 5th time he's won a similar award in the last 7 years.
Before we get into the main segment of this week's show, where Ken Race and I discuss at least 6 taxes that could be introduced if Labor comes in, and how this tax grab is going to affect you as a property investor and just as an ordinary Australian, I want to spend a couple of minutes explaining to you why I think there are so many people currently predicting a property market crash. You know, you've seen the headlines, the property market's going to crash, property values are going to drop 30-40%. That's the typical headline the media is currently using to draw you in, isn't it? If they write something like, the long-term property market fundamentals are sound, it's unlikely to have you bothered to click the link. So have you wondered why there are so many property pessimists when long-term optimism is the most realistic stance? Well, the media loves to tell us that the property market's going to crash, and it gives plenty of airtime to commentators with this view. But there's nothing new about this. In fact, part of this is natural. We've evolved to treat threats as more urgent than opportunities. Warren Buffett said it wisely, in order to succeed, you must first survive. But all the current property pessimism about the economy as well takes things to a different level. I've found that if you say there's going to be a property market downturn, you get retweeted. If you say there's going to be a big downturn, the newspapers will quote you. But if you say we're about to head for the next global financial crisis and property values are going to drop 40%, you end up getting on television, don't you? However, if you mention that good times are ahead, that certain property submarkets at the moment are going to finish the year higher than they started, and that our property markets are not going to crash, a common reaction from commentators and spectators alike is that you're either a salesman or that you don't understand the true risks. So I'd like to share with you 3 thoughts about what's going on here. The first one is that money is universal. What I mean by that is that if something bad happens, it tends to affect everybody, albeit in different ways. Now, that isn't true, say, of the weather. A hurricane barrelling down on far north Queensland doesn't pose a risk to 95% of Australians. But a recession barrelling down on our economy could impact every single person, including you and me. So you pay attention to those headlines. And of course, this also applies to the property market, where around 70% of us own a home or are paying off our home. So a second reason why there are so many property pessimists, and the media loves it, is pessimism requires action. Bad news means you may have to sell something, you may have to run away, you may have to hide. On the other hand, optimism is mostly a call to stay the course. It's not nearly as urgent, is it? And the third reason I'd like to offer you as to why there are so many interesting predictions about the property market at the moment is because there's a lot of money to be made in the property advice industry. Currently, there's no regulation of the property advice industry, the property investment advice industry, and that's a bad thing. All other investment advice is regulated, and that's one of the reasons I was a foundation member of PIPA, the Property Investment Professionals of Australia, to try and get this industry regulated. But anyway, while there are some very professional people and organisations around to help investors, because of the potentially large amounts of money involved in the property investment advice industry, it's attracted an army of, let's call them truth benders, promising the moon. You see, a big enough commission can convince even an honest, law-abiding salesperson that dud properties and I'm looking at you, off the plan properties, I'm looking at you, house and land packages, I'm saying that these dud properties are sometimes being sold, often being sold, unfortunately, to customers by people telling them it's in their best interest. Over the years, too many people have been bamboozled by these property spruikers' version of optimism. By the way, most promotions of optimism are realistic, but of course not all are. So just so you understand what optimism is, real optimists don't believe that everything's going to be great. That's complacency. Optimism is a belief that the odds of a good outcome are in your favour over time, even though there's going to be setbacks along the way. I've read that the simple idea that most people wake up in the morning trying to make things a little better and more productive, then there's fewer people waking up wanting to cause trouble. I believe that's the foundation of optimism. Now, that's not too complicated, is it? But it's not a guarantee either. It's just the most reasonable bet for most people. So my recommendation to you is don't become a property pessimist despite what the media is trying to sell you. Instead, become a property realist. Before I have my chat with Ken Race, I just want to follow through some of the thoughts I just said about pessimism and optimism and explain that one of the ways to become realistic, optimistic about your business, about your life, about property is to hang around other already successful optimistic people. And that's one of the reasons for the last 13 years I've been running Wealth Retreat, which is Australia's premier learning and networking event for not just property investors, but for entrepreneurs and business people. It's allowed them to create lifetime wealth and leave a legacy. You see, when people come and join us at Wealth Retreat in June on the Gold Coast, they go home a very, very different person because they spend 5 days networking, masterminding and growing with a room of like-minded movers and shakers and doers, not pessimists. This means if you join us this year, you're going to go home with an expanded mindset, a new set of goals and a toolbox full of tools to help you build a true property investment business. And if you're in business or profession, boy, you're going to enjoy the special sessions for those people and for share trading as well. You're going to be joined by Tom Corley, who's coming from the United States, Dr. Andrew Wilson, Pete Wargent, Ken Race, myself, Mark Creed and finance brokers. We've got a whole faculty of experts, and because the group, the attendees, is kept to only 50 people, you're going to have lots of one-on-one time with us. So go to wealthretreat.com.au, find out about it, register your interest. I speak to all prospective attendees to make sure it suits you, so don't count yourself out. wealthretreat.com.au. I look forward to spending 5 days together with you in June. Hi, I'm Michael Yardney, and no one likes to pay more tax. Now, I recognise I've got to pay my fair share of tax. In fact, I do. I recently got my new land tax bill, and boy, have I paid my share of tax this year. And I also realise that if Bill Shorten becomes our next Prime Minister, millions of Australians are going to have to pay higher tax. And by the way, he's not just after greedy, ugly property investors. If Labor Party does win, and I don't want to make this a political discussion, but if Labor Party does win, and he does introduce some of the taxes or most of the taxes, I don't know if you realise Australia is going to be amongst the most highly taxed nations in the world. So in today's think tank, I'd like to discuss with my business partner, Ken Race, some of the taxes that may come into effect, how they may affect you and what you can do about it. So at the end of this session, you're going to be a more informed investor, business person, entrepreneur. So welcome, Ken.
Hi, Michael.
Now, Ken, I've called this masterclass 6 new taxes that Labor proposes to introduce. So what I'd like to do is go through what we currently know about this, because most people aren't even aware of these. We all keep talking about the negative gearing and the capital gains tax, but there are other things that could weigh us down. Hey, that's a good slide for that. And on that basis, let's get your understanding of what's going on. And the reason I've asked you to be involved is because I see you as a tax strategist. I know you're my tax strategist. So sure, you're an accountant and sure, you're a CPA. None of this, what we're giving today, is financial advice, because you're also wear a financial planner's hat as well. This is general information, but you've got that broad perspective to give strategic advice to our clients to help them get in the right point in the right direction. And then their accountants, their lawyers, their solicitors actually carry that out. So the one we tend to talk about, as I said, the property related taxes, but this is one that scared me, Ken, that if Labor Party do come into power, over time, they're planning to increase the top personal tax rate rather than decrease it.
Correct. I mean, and just to put some scale around it, there's over $200 billion worth of new taxes that the ALP want to introduce. And some of them will impact people straight away, and they're the ones that tended to get the headlines. But there's some real slow burns in there that people don't actually see the impact on them for maybe 10, 15, 20 or 30 years. And that's the insidious part about it, because it's almost by stealth. So increasing the top marginal tax rate, that's the one that we're going to see straight up. So the highest tax payable at the moment is 47% with the Medicare levy, and the ALP want to increase that to 49%. And a lot of people say, but it won't affect me. I'm not in that highest income bracket. But there'll be a doubling of the people caught in that bracket over the next 6 years. So there'll be over 1 million new people that will go up to that highest bracket, either through what they call bracket creep. So as inflation and as your wages increase, you move into the next bracket. So one part of the political movement, the Conservative Party, wants to reduce people's tax rates. The ALP, on the other hand, want to increase it, take money from you because they believe they can spend it better than you can.
Well, now that's a good question. Who can spend your money better? I think my wife knows how to spend my money really well. I'd rather have it in my pocket, Ken. Now, the next thing that we tend to be talking about is a higher tax on capital gains. And that's not just property, but for many people watching this, it will be property, won't it?
Correct. So obviously any asset. So, if you've got paintings, that sort of
Shares.
stuff, gold, shares, property.
Probably even Bitcoin that some people are into.
Correct, because that's an investment. So we're actually seeing that this is a very broad tax. And what we saw is that if you hold those assets for more than 12 months, the government gives you a discount so that you pay lower tax. And the reason that they're giving you a discount is because they're trying to encourage Australians to invest, to maybe get off the public purse in the latter years, to help stimulate the economy, to improve efficiency in the economy. So they're trying to get people to invest and saying, if you do, at the end when you sell those assets, I'll reduce your tax by giving you a 50% discount on the capital gain. What the ALP are wanting to do is reduce that from 50% to 25%. So you will now pay tax on 75% of that capital gain. And just to put some statistics around it, if you were looking at the current tax system, where the highest marginal tax rate's 47 with a 50% discount, you're actually paying tax at half that rate. So half of 47 is, 23 and a half. But at 49 with an increase, meaning you're going to pay tax on 75%, you'll actually end up paying tax at a much higher rate.
36.75%, Ken, from 23%.
Correct.
That's almost a 50% increase, isn't it? It's actually
Correct.
a 56% increase.
Correct. So on $100,000 capital gain, the new Labor Party tax system will tax you $36,750. versus 23,500, which, is $13,000 more. And as you said, a 56% increase. Imagine telling people, I'm going to increase your taxes by 56%. But the way they tell the story, it's almost hidden.
So, Ken, tell me, is this higher tax on capital gains going to be grandfathered, or will it apply to properties I already own?
Look, don't know the answer to that, because the Labor Party has been talking or trying to have one foot in each camp. So at this stage, there's a high probability that assets owned at that particular date may not be grandfathered, but that's something that they're
grandfathered.
Yeah,
That's interesting.
So,
now, of course, all this is theoretical. All
correct.
This is proposed. Some of these may not come in, but I think what we're saying is be aware of what could happen and see a good tax strategist who is going to be able to protect you. So one of the other ones we've spoken about a bit, but in short, the Labor Party's aiming to limit negative gearing from a particular date, and there's a lot of negativity in the media about this at the moment, and it will restrict negative gearing to new dwellings. Now, it's well known that these are the sort of properties that are not particularly good investments. They're not particularly good investment grade properties. Sure, some new townhouses and some new homes in the right suburbs are, but for most investors, in my mind, Ken, they're going to buy off the plan properties, new CBD properties, or house and land properties in the new estates. The problem is, the minute they've bought them, they're no longer new. It's like buying that car and moving out the car yard, and they're going to be a limited market. So I think it's going to compound investors' errors. They're going to buy the wrong sort of properties, and they're not going to have a secondary market for it, Ken.
Correct. And if we look at the underlining reason why the ALP want to introduce this tax, it is to actually put downward pressure on house prices. So it's not an exaggeration to say that this policy could very well and will very well reduce prices. So what they're doing is they're applying a strategy that will affect 100% of property owners when they're trying to make life easier on between 10 and 15% of first home buyers. So that is an absolute sledgehammer to attack. So
there's going to be a lot of interesting media about that between now and the election.
Yep.
Now, I've called the next one a retiree tax, but it actually doesn't only affect retirees. It affects anyone who gets imputed credits, because a lot of business people, including me, use this legally correctly, and people in their super funds have shares. So maybe you can explain a bit about what this tax is, Ken.
Yeah. So when you own shares in a company, you're an owner in that company. And as an owner, you get a distribution of those profits. But the company doesn't know what your tax rate is. So the company tax rate is paid by the company. And then when you get your dividend, you are allowed to say, I've already prepaid 30 cents. So therefore, I'll only pay a top-up tax if my tax rate is higher. But if my tax rate is lower, I'll actually get a refund, exactly the same as on PAYG. If you've overpaid your tax during the year, you get a refund at the end of the year. So what the ALP, the Labor Party, is saying is they will no longer allow the cash payment back of any overpaid taxes. So that's going to impact, obviously, retirees today, because they're actually seeing that money in their super fund. But other people who aren't retired, who have just got investments, won't receive that cash back if they're on a lower tax rate. But insidiously, everybody in a super fund will actually have less money being contributed back into the super fund, because they won't get that cash back, which means they will see their super fund not grow at the same rate, which means over 10, 15, 20 years, when they finally get to pension stage, their super balance will be much less than it otherwise would have been.
That's interesting. Most people don't recognise the insidious nature of it. And you said it well right at the beginning, Ken. It doesn't sound like much today, but compounded over the years, and it gets quite expensive for us.
Yeah.
We're going to lose out. Now, a lot of property investors, business owners have what we call discretionary trusts or family trusts. And up till today, it's a very efficient way of protecting your assets, passing on your assets, estate planning, and there are some tax benefits. And I know that you've never recommended them just to get a tax benefit. That would be the wrong way of doing it. But there is no reason why you're not being able to take advantage of it, because you can distribute to family members, other trusts, other businesses. But now they're talking about taxing discretionary trusts, Ken.
Correct. So they're still going to allow discretionary trusts, but what they're going to do is tax them at the source, not when you receive the money. So again, they're going to tax it now at the 30 cents tax rate. So that means if you receive money from the family trust and you're at a lower tax rate, that means you will pay a higher rate than otherwise you would have. But let me just say this, for many people out there, a family trust, you may still get the same benefit of a receiving money at an efficient tax rate using a slightly different trust. So again, it's going to be horses for courses. So that's why you need to come and get specific advice for your circumstances, because all is not necessarily lost.
Well, I know that, Ken, because you've been helping a number of our high net worth clients at Metropole, but it's actually not just for high net worth clients. So Metropole Wealth Advisory, your team services help our clients, as we say, grow, protect and pass on their wealth. But what we also help them do is stop losing the leakage, because if you can grow your wealth more effectively by legally paying less tax and using the system correctly, as at the same time protecting your assets, it's a great way of doing things. So Metropole Wealth Advisory, and we'll give them our viewers an opportunity to find out a bit more about it at the end of this webinar, is probably a good place to visit. You as a tax strategist, it would be a good person to have on one side, I know I do, to help minimise unnecessary taxes. Now, there's a whole raft of superannuation changes. And again, superannuation is a very specialised area. And this is not the purpose of this webinar, other than to say that if you're planning to have a self-managed super fund, or if you currently have a self-managed super fund, it is worth getting this sort of advice that you, Ken, and your team at Metropole Wealth Advisory give, because there are ways of minimising the effect on you.
Correct, because there's a number of changes under this heading. So certainly people on certain incomes now will start paying 30 cents on the money they put into super as opposed to 15. But there's a lot of low to medium income earners that are going to be impacted by these changes. By not being able to put as much into super as frequently, people won't be able to catch up if they've had a year where they've had high expenses, so they've put a little bit less into super. You're allowed to catch up in future years. They're going to be getting rid of all that, which is going to impact people who might be on part-time work, who are going to then go to full-time, or a partner who maybe stayed home to look after children, who then go back into the workforce. So those benefits that they've had for some time will be taken away from them.
Now, it's not as if we're not paying enough taxes already, Ken. Australia lies more on personal income tax compared to other taxes than all other OECD countries other than Denmark. Others have a VAT tax or GST tax that is higher, but our government currently and planning in the future relies very heavily on one's personal income tax. So if you're like me, you're not only paying tax, which could be at the moment up to 47%, and also 2% Medicare levy, there's 10% GST on most things you buy. Of course, this is often hidden and forgotten. And then there's tax on your superannuation contribution. And as a property investor, I pay stamp duty and I pay land tax. Boy, do I pay land tax. And because I've got things in a trust, I pay even more land tax. And there's the shares in my superannuation fund and my share portfolio. I pay my implied share of this. So it's interesting that the potential consequences, and unfortunately, the more complicated one's affairs become, the more assets you have, the more complicated your tax affairs are. So I, again, really believe it's important to see a tax strategist. Are there any other little hints you want to give us at this point, Ken?
Look, just to round up on what you said, property is by far the most taxed asset. You know, by the time you take council rates, water, insurance, stamp duty, all the rest. And in fact, over 40% of a new property's costs are government taxes and charges. 40%. So, and it's almost the golden goose for any government to be able to generate income. So what we need to do is understand those different levers that we've got to control the outflow of those taxes. And different levers you'll be able to move to different degrees. So some things, you know, we've helped clients eliminate completely, particularly in some stamp duty or land tax transactions. Others you'll only be able to change the taxes in a small way. Others you won't be. But think of it as a broad range of levers that we've got to look at each single one and see what we can do in each of those to, if I can say, reduce the overall burden. So see that we can reduce the overall tax burden and then put in place strategies to help protect and pass on, because we are moving into a significantly more litigious society. We want to protect our assets if it goes to children, that it doesn't go to in-laws, and the list goes on and on. So we need this broad approach to managing our wealth now and in the future, and then to the next generation, which is what we do for our clients.
So if watching this webcast, this think tank, as I like to call it, has made you wonder, is there a way I can protect my assets better? Is there a way I should structure my things better? Then I recommend you catch up with Ken, go to metropolwealthadvisory.com.au, or just go to the Metropole website and you can find out, or ring us at 1-300-METROPOLE. And why not have Ken give a second opinion? Now, sometimes there are things you can change, Ken, and I know that there are other times there's not a lot you can do. You don't want to do their taxes, you don't do tax returns, but giving a second opinion for somebody who's already established, or if you're about to go into a business or about to set up a property purchase, then that's better to do it beforehand, because it's going to save you heartache and a lot of cost later. And we're looking at it in a holistic way. Metropole.com.au or 1-300-METROPOLE. Ken, thank you very much for your time.
Thank you, Michael. Great chat.
As we're getting close to the end of another show, I'd like to read out 2 5-star reviews I recently received. And if you leave a review and I read it out on the show, just email me at michael@metropole.com.au and I'll gift you one of my books as a way of saying thank you. But if you got some benefit from today's show, please pass the message on to somebody. My intention is to help as many people become financially aware, financially fluent, financially independent. And the way to do that is by educating them. So if you could please let others know about the show through Twitter, Facebook, just sending them a link, that'd be great. Now, Austin Gann left a great review saying, "Thanks, Michael, for spending this valuable time on the podcast, educating people on property and investing. Every person who's involved in property should listen to this. It's informative and unbiased, unlike the typical type of media that only reports half-truths." Well, thanks for that perspective, Austin. And Stephen CC3 wrote, "Hey, Michael, thank you for sharing your knowledge. The information is valuable and timeless and helps people keep things in perspective. You call it as it is and your achievements speak for themselves. Lucky to find you." Well, thank you so much, Stephen. And I look forward to joining you again in a week's time with the Michael Yardney podcast.
Thanks for listening to this week's episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect and pass on their wealth through strategic property advice. If you got value from today's show, we'd really appreciate it if you would leave a review, and we'll read it out on a future show, and Michael will gift you one of his books as a way of saying thank you. Just go to michaelyardneypodcast.com/review and let us know what you think. If you don't already subscribe, head over to iTunes or your favourite Android app. You'll find us there as Michael Yardney Podcast. If you'd like to gain instant access to the show notes, head across to michaelyardneypodcast.com. Watch out for our show next week. You'll learn some new ideas about property investment, success and money in around 30 minutes.